Task 4.7. Task 4.7 is like trying to figure out a puzzle. So you have to see what can you get first, and then you realize there's quite a number of items missing. The first place where you need to start is to determine the method of depreciation that they use in this exercise that wasn't given. But what you see from both exercises is from both vehicles and equipment is that there are some amounts at the beginning of the year and there's some depreciation for vehicles. And then you see the depreciation for equipment only starts in February the 28th. Both of them at the end of the first year. But there are no information as to how to determine it. So this is what you have to find first. Now, if you look at, when you get to something like that, you start with a formula. You know, they tell you that vehicles will be depreciated on the diminishing balance method, meaning on the carry value, meaning cost price minus accumulated depreciation. So you start by writing down your original formula. Cost price minus accumulated depreciation times the percentage of 100. You want the percentage. Now you try and find this information from the information that's given. Now if you look at accumulated depreciation on vehicles, you will see that it says there that the depreciation for the first year is 62,500. So they gave you this. They also indicate the cost price of the vehicle. At the beginning of the year, it says bank CPJ 250,000. And then there's a missing amount for a new one that was bought. But if you look at the new one, it's bought right at the very end of the first year. Therefore, you don't need to worry about that because that one was not used during the year. So there's no depreciation applicable on the new vehicle bought on credit. You don't need to worry about that one though. Obviously, you could work that one out because you know the total 250 plus something will give you 400,000. So that was the most easy one to fill in, 150. But you don't need to use it when you're working out your formula because you didn't use it during the year. So now you take that 250 minus 0. There was no depreciation written off on the first one previously. There was not an opening balance for accumulated depreciation. So you work it out like this. How do we work it out then? I take everything 62,500, take this to the side, then I divide, take that to that side, then I multiply. And that's where you get your 25%. Okay. Now let's look at equipment. Equipment was a little bit of another story. If you look at equipment, you will see that it must be depreciated at cost. But then you see this little item was bought during the first year. So we didn't have an opening balance there. It's bought during the year. So we used it from the 1st of September. So, and that's all that we had for the first year. An item that was there for the first year. But what they tell you though is that if you then take the depreciation for equipment, you need to know that it's half a year. So if you take, again, depreciation, 16,500, where do we get that? You'll see in this exercise I've got 8250. You'll have to double it because that was just for you. We work to try and find the percentage for a year. We work for a year. So you need to take that amount that you've got there and you have to double it because I know the real answer is just half. But if you want to find the percentage, you need to work it out for the year. So if we would have had that for the year, we need to double it, which then give me the 16.5 for depreciation. And it's on cost, so if you work it out, then you get the 15%. All right. So that was a bit of a tricky one, but it's very important that you do work through this exercise very well and to be able to determine this, because going forward this year and next year, you might find that they pop in something like this every now and then. So please make a big note next to this exercise that you can understand how to work out the depreciation. You can ask me again if you struggle. Now, once you've got the percentages, now you can go back and go work it out. All the missing figures that you don't have in accumulated. And you know, accumulated depreciation goes for old, new, and sold, but we don't have sold yet. So you do old and new. If you look at vehicles, the first one, there's your accumulated, it's on the diminishing balance. That is the amount times 25%. The first year one was already worked out for you, so you didn't need to do year one. You can only start with year 2, and then you do year 3. And then there was a new one bought cash on the 31st of August. So you don't count August, you start counting from September, and that's for 6 months. And obviously new ones will never have any depreciation that accumulated from the past. So you work straight with the cost price. And then there's another one on the third year. Again, it's accumulated depreciation. But look at this one. You've got two new equipments there. The total accumulated for the 2 years. All right. Sorry, I'm not busy with equipment. I'm busy with vehicles. In vehicles, they've done that there. You will struggle with that. What would you have done? You would first balance your accumulated depreciation account after every year, because it's a B account, it must be balanced. So to find the balance, that is it. So if we work on our formula, we always say cost price minus accumulated depreciation. And the accumulated depreciation is 164. And then you work it out times 25% for the year. So that's how you work out vehicles. And then you take equipment. Now you can work out the depreciation because you know the formula, the percentage. What was it? It was there for how long? For 6 months only. And then the second year, there's the old one, there's the new one. How many months? Only 8 months from June. And you'll see there's another new one, but you only bought that one right at the end of the year. So there's no depreciation needed on that one. And then you go to number 3, plain and simple. Only the opening balance was given there, 15% for the year. So in year 3, we did not buy any new equipment. And that is how you calculate it. And then you just literally fill in the missing amounts. So for me, the very important part in this exercise was first to understand how to determine the percentage, and then doing your calculation. Show what you will see. The book doesn't do that, but we want you to always show what you're using, new, old, and you're going to have sold as well. After this exercise, 4.9, we're starting with asset disposal, when we sell an asset.